Ever nailed a trade, only to think, I've got this market figured out, and then get blindsided the very next day? That's not bad luck. That's your brain playing dirty tricks. Today, we're cutting through the fog of now, the sneaky psychological traps that make you overvalue the latest data, cling to the wrong numbers, and see patterns that aren't even there. In trading, every chart, news headline, and price tick feels urgent. Your brain tells you that what just happened, yesterday's rally, this morning's crash, is the most important piece of information in the world. That's recency bias. Then there's anchoring. When you latch onto one number, like Bitcoin hit $50,000 last year, and refuse to update your expectations, even when the market's screaming otherwise. And finally, the illusion of clarity. When hindsight makes you believe that everything was obvious all along. That's the "I knew it" voice in your head after a move happens, conveniently forgetting that you were just as confused as everyone else before it. These mental shortcuts aren't random. They're baked into human psychology. But in trading, they can cost you real money. They lead to overconfidence, bad entries, stubborn exits, and a dangerous sense of certainty in an uncertain game. In this episode, we'll break down how these three biases work, why they mess with your decision-making, and how to stop them from sabotaging your trades. I'll give you real market examples, the mental traps behind them, and practical ways to clear your head before you click buy or sell. Before we continue, I want to thank the sponsor of today's video, Noesis. Noesis is a platform built specifically for traders who want to level up their consistency and mindset while avoiding mental pitfalls. It gives you tools like a daily mental check-in, a trade journal, and an emotion wheel to track your state while trading. On top of that, it includes structured playbooks, which are strategy checklists that you can go through before and after each trade, plus a playbook marketplace where you can explore proven strategies from other traders or share your own. If you're serious about developing the psychological edge that most traders ignore, Noesis is worth checking out. You can get started today at noesis.zone. Link in the description. Recency bias. When the latest feels the greatest, recency bias is when you overvalue the most recent information and ignore the bigger picture. If you've ever taken one great trade and then felt like a genius, only to blow up the next position, yep, that's recency bias at work. Example. Let's say you've been trading a stock that's been trending down for months. Suddenly, it rallies for 3 days straight. Your brain lights up and says, "The bottom's in, time to load up." But what's actually happened? You're focusing on a tiny blip of upward movement and ignoring months of downward momentum, bad earnings reports, and a weak sector. Why does this happen? Evolution. Our ancestors survived by reacting quickly to recent threats, but markets aren't tigers. The last 5 candlesticks don't tell the whole story. Fix it. Use a multi-timeframe checklist. Before acting on short-term data, zoom out to the daily or weekly chart. Keep a trade journal that forces you to justify decisions with more than "it's been going up-down lately." Ask, if I didn't see the last 48 hours of price action, would I still take this trade? Anchoring. The number that won't let go. Anchoring happens when your brain grabs onto a reference point, like a past high, your entry price, or even an analyst target, and refuses to update based on new evidence. Example. Imagine Apple's stock peaked at around $195. You might mentally lock that in as the true value. When it drops to $160, you see it as a bargain. Even if earnings growth is slowing, supply chain risks are rising, or broader market conditions have shifted, you're anchored to an outdated number. Why does this happen? Anchoring is a shortcut our brains use to make decisions faster. The problem is, in markets, conditions change constantly. A number that mattered last month might be irrelevant today. Fix it. Re-anchor every trade idea. Ask yourself, if I learned about this stock today for the first time, what would my target be? Use percentage-based thinking instead of fixed numbers. It's harder to get emotionally attached to up 12% than $195. Periodically delete old price levels from your charts. Clean charts equals cleaner thinking. The illusion of clarity. Hindsight's favorite trick. The illusion of clarity is when everything seems obvious. After the fact. That big rally? Of course it happened, you tell yourself. The signs were everywhere. Except they weren't. Not until your brain rewrote the story. Example. Remember GameStop in early 2021? After the spike, countless people claimed they knew it would happen because of short interest data and Reddit chatter. But before the squeeze, most of those same people weren't trading it. Why does this happen? Hindsight bias helps our brains feel more in control of a chaotic world. But in trading, it creates a dangerous false confidence. You start thinking your past trades were more predictable than they really were, which leads you to take bigger risks next time. Fix it. Write down your pre-trade reasoning before you enter. Later, compare it to what actually happened. Track both your wins and your losses with equal attention. Don't just study your winners. Accept uncertainty. If you can't clearly explain why a move might not happen, you're probably falling for the illusion. When they all work together, the perfect storm. The real danger in trading psychology isn't any single bias. It's when they stack on top of each other. Think of it like bad weather. A little rain? Fine. Some wind? Manageable. But when you get rain, wind, and fog all at the same time, you're in for a rough landing. Here's how it plays out. You start with anchoring. Maybe a stock was at $100 last year, and you lock that number in your mind as true value. That's your mental lighthouse. Then, the stock tanks to $60. At first, you tell yourself, no problem, it's a discount. It'll bounce back to $100. Now, throw recency bias into the mix. Over the next week, the stock climbs from $60 to $68. That short rally feels huge, and your brain screams, the recovery has begun. Time to buy big. Suddenly, you're ignoring the larger downtrend and loading up based on just a few green candles. Finally, the illusion of clarity kicks in. The stock drops to $62 the following week, wiping out most of that gain. You look back and think, ugh, it was so obvious that rally was fake. I should have seen it coming. In reality, you didn't have any more foresight than anyone else. You just edited the memory to make yourself feel in control. When these three biases run in sequence, they create a mental loop. You fixate on an outdated price, overreact to short-term moves, then rewrite history in your mind to make it all seem predictable. This loop can cause you to average down into bad trades, hold losers too long, and overtrade during volatile periods. Breaking the loop starts with awareness. When you catch yourself referencing a true value or target from the past, stop. Ask, has the market environment changed enough to make that number irrelevant? If you're feeling extra confident after a few good days, zoom out and check the long-term chart. And when you're tempted to say, I knew it, pause and review your pre-trade notes. You might surprise yourself. This isn't about beating your brain into submission. It's about building a habit of challenging your first reaction. In trading, the first story your brain tells you is often the most biased one. Recency bias, anchoring, and the illusion of clarity all live in the same neighborhood in your brain. They feed on your desire for certainty and speed. But markets reward patience, context, and flexibility. So, here's your challenge. For your next 5 trades, write down your reasoning before you enter, including what would make you not take the trade. Check multiple time frames before hitting the button and scrub outdated price levels from your charts. The goal isn't to eliminate bias completely. That's impossible. The goal is to recognize when it's whispering in your ear and have a system in place to double-check yourself. If this episode helped clear the fog of now, hit that like button. It tells YouTube this content's worth showing to more traders like you. Drop a comment sharing which bias you've struggled with most. I read them all. And don't forget to subscribe so you don't miss our next episode, where we'll tackle the overconfidence trap. Trading isn't about seeing the future. It's about navigating the present without getting blinded by it. Stay sharp, trade smart, and I'll see you in the next one.